Today, the conversation that we're going to have is around cash flow challenges for emerging fund managers. It sounds niche. I will argue that it's actually one of the most core underpinning issues around access to capital challenges in the small business and startup business community worldwide. And I think if we don't solve this problem, we never get new and more interesting and innovative and different fund managers, and therefore we don't get different sort of perspectives on investing and capital allocation. So I think it's actually a really fundamental issue, but I also hope that we can get into some of the nitty-gritty and some of the factual specific details in this conversation today. A little bit about myself. My name is Michael. My partners and I run an organization called Catalyze. We support emerging, underrepresented investment fund managers here in the US specifically. We do that with an annual time-bound fellowship program, so it's like an accelerator program for fund managers raising their first funds, and we're also raising a fund of our own, which is a loan fund to provide working capital loans to GPs who are raising their first few funds. So happy to elaborate more on that subject, but that's why I and my partners are passionate about this issue in particular. And it's also the reason why we get to know some amazing GPs like those sitting on the stage next to me today. So instead of me introducing my fellow panelists, I would love to let them introduce themselves. And we're going to hear a little bit more about their journeys and their sort of trajectory to where they are today in our conversation today. So I'll let each of the three of you maybe just go down the line, tell us about who you are, maybe something that folks wouldn't be able to learn about you from your LinkedIn or from your website, and something sort of human about you and your work. And then we can dive into the sort of like specifics of you and your businesses.
Hi, good morning. Come on, guys. Morning. Morning. I know everybody has, like, you know, the vocal cords aren't at the top notch, speaking for myself, but it's great to see all of you. I'm Sonam Villani. I am the co-founder and managing partner of Street Life Ventures. We are a New York City-based early-stage venture fund investing at the intersection of cities and climate. That means, you know, half of humanity lives in cities, 70% of emissions come from cities. Unfortunately, both of those numbers are going up and to the right. So we very much so believe, how do you change the conversation from, frankly, a lot of doom and gloom that is climate change to agency and optimism and get solutions out in our streets and neighborhoods. My partner Laura and I, this is our first fund. My partner Laura and I have spent our entire careers at that intersection of cities and climate, and we have been incredibly grateful for support from a number of emerging fund manager programs to get us to where we are. So I'll talk a little bit about that later.
Yeah, surprise, we can't find out about you.
Oh, one thing you can't find out about me. I think this might be somewhere, but I grew up as an undocumented immigrant in Chicago. I think that's what a lot of what drives my passion for this subject, right? And personal challenges with environmental risks in my community. So it's all about sort of paying it forward, right? And how do you do that with all of us, with our lived experiences and supporting founders and funders in this space?
Awesome. Good morning. I'm Lauren Gratton. I am co-founder and chief community officer of Mission Driven Finance. We are sat in order of our faces on the screen, or maybe reverse order. Order to me looking at my face down here. But we're a little bit out of order in terms of like what might naturally make sense. Mission Driven Finance is an impact asset management firm. We design, develop, and manage private impact funds, also focused on the US. But we work sometimes we're doing that ourselves, designing the thesis, but oftentimes we're doing that in partnership with folks that are wanting to build a fund, but don't have all of the mechanics to make that happen. And so we focus on 3 areas where we can be uniquely helpful, and that's missing middle business financing, impact real estate, and supporting funds and intermediaries, the last of which is why Michael had us join here today, how we can be really addressing some of these key challenges. We work all over the country in all sorts of different places to build a more inclusive economy, which is very broad, but we really believe in changing the system of how capital moves so that we can have more rad funds coming online and really getting capital to communities that have been overlooked and underestimated for far too long. Things that you could find out about me if you Googled hard enough. I am a huge fan of cheese, tea, and yoga, and that gives you a lot of information about me, I think.
Thank you. So before I introduce myself, how many of you are fund managers, GPs? All right, it's good to know. How many of you could be potential investors, LPs, in the room? Yay! All right. And how many of you love life?
That's good.
How many of you know how much your investments are aligned to your love of life? Great. So I'm a biophilic myself, a lover of life. I'm also a mompreneur. So I used to be a banker. I'm recovering. It's been 10 years. But I mean, it was a good thing. I did learn about wealth management. I did learn about asset management. I did have an experience in the 2008 crisis that some ex-bankers might remember, or bankers might remember, in Mexico, where, you know, people just put a gun in front of you and say, "Where is my money?" So really had to learn about wealth management and asset management in a rush. After that, I think I had like a, how do you say, like a turning point? A catalytic moment in a panic attack some years later, that I was doing really well in terms of the bankers' ranking in Mexico, but my health wasn't. And so many of the signs in my life pointed towards, this is not what you were supposed to do. And if I was being a little dramatic and said, okay, if I die tomorrow, did I do something right? Or did I just make the rich richer? And so when I started questioning that in my life, I started to take a new path. And I found impact investing. And at the very beginning, I was like, wow, mesmerized about impact investing and drinking all the Kool-Aid, about doing well while doing good, and all of that. And I was like, wow, this is amazing. I actually found some partners in Canada, Kevin over there from SBX Canada, but actually Adam first. And I was like, hey guys, can I learn from you? Can I take the SBX model from Canada to Mexico? And they have been absolutely amazing and collaborative, without owning us, without, nothing like that, just being very collaborative and showing me a lot of the how and a lot of the who was very important. So like showing me the way, being mentors. So I started SBX Mexico back in 2014. So it's been 10 years. And it's an impact investing advisory firm. And at the beginning, it was all impact investing. We started doing a ton of investor education in Spanish. We were the first ones to do it in Spanish all across Latin America. But we were not just translating, but also doing a little bit of thought leadership, like what is useful from impact investing for Latin America, and where is the Latin American essence within impact investing, and how do we express that through the actual transactions that we do and how we manage portfolios. And so that is how we started in SBX Mexico. Then later, I started feeling like maybe impact investing was too broad, and I needed some clear direction. And that's where we found a regenerative economy. And we found climate adaptation and biodiversity. And I was like, wow, that became our North Star. So our mission is to ensure that capital serves life instead of governing it. So really eradicating and questioning the paradigms of domination in finance to become paradigms of interdependence and service. And so that has been the light and northern star of our work ever since. And now we're launching our first fund, which is Regenera Ventures, and I can let you know more later.
I can't believe that I have to follow that. Thank you both, or all three of you, I should say, for those incredible introductions. I'm glad that we all know more about you. I was noticing we were gaining new entrants and visitors as you were introducing yourselves. So if you missed the introductions from our panelists, Google them. Things you won't learn on Google include Lauren's affinity for cheese, which, Lauren, I will admit, I'm a big cheese fan, and I think cheese gets a bad rap in 2024. Cheese is an old food, folks. We can't be letting cheese sort of fall off in cultural popularity. Big fan. Thank you all for introducing yourselves and a little bit about yourselves. I should say for the folks that have just joined us in the room, the sort of underpinning, at least in my opinion, the underpinning current here of our discussion hinges upon the idea that we believe there is value in seeding and supporting first-time and underrepresented fund managers. And if you're in the room and that doesn't sound like something that's worthwhile, then maybe you're at the wrong conference. But maybe just to refine the idea, we believe at least our organization believes that that's a worthwhile endeavor, because we believe that people from underrepresented backgrounds and people launching new funds approach investing differently, and they do so because of their lived experience and their ability to find opportunities in communities that look like them, in the communities that they're a member of. So if we only have investors who come from certain communities, they tend to see opportunities where they are comfortable being in the communities that look like them, which is a natural implicit bias we all have. And so when we bring different investors to the table and offer capital from different investors to different entrepreneurs, we think that we get greater capital access outcomes. So I just wanted to sort of highlight that as sort of like the theme upon which we're working. I also wanted to highlight for the folks that are just joining us in the room, there are either cards and pencils on your table, or there will be, and we're going to have time for Q&A today. Some of the folks in the room are going to collect those cards from your tables in a little bit. We'd love to be able to bring some of your thoughts and ideas for discussion among the GPs on the stage here. So please feel free at any point, if there's something you'd like to write down for us to discuss, a question, a prompt, go ahead and put that on paper, and we'll make sure that it gets up here and filtered out. If it's only applicable to one of our 3 panelists, then maybe you can just find them after the fact, and they'll address it with you individually. So I wanted to pivot to some specific discussion, and luckily we have 3 fantastic panelists here who are comfortable being honest and real, and I think too many panelists or too many panel discussions are kind of just like repetitions of things you could have seen on a website. So we'd love to hear a little bit more from our panelists here about why is it so expensive and complicated to raise a fund today. We've seen stats that in the recent years, new fund launches are down. It's harder to raise a new fund. It's a tough fundraising environment in general for private funds. Why, in your experience, is it so hard, costly, and complicated to raise a fund, not just from the financial side, but also from the personal risk and opportunity cost side? What other things are you sort of giving up, and what are the human costs associated with raising a fund? So we can go in whatever order you prefer, but would love to hear from your experiences.
Sure. So I'll start with another audience question, and we'll put it out there for you all. How much does it cost to raise a $50 million fund? Wild guess.
Shout it out.
Shout it out. You are not a shy crowd. I know that because I talked to many of you yesterday.
1 million. Oh.
1 million. 2, 5. Okay. Okay, good range of guesses. I would say it's about, $1 to $3 million, right? And frankly, for those of us who don't come from wealth, we don't have $1 million lying around, right, to start these organizations. And I think that's the crux of, Michael, what you were talking about, right? How do we actually diversify the ecosystem when the startup cost, the cost of entry is so high? I would say, from a personal perspective, both myself and my co-founder Laura, I mentioned I grew up undocumented. We're actually both from Chicago. She grew up on the south side of the city. We don't come from these networks, right? We don't come from these places. And frankly, we have to fund a lot of this and our startup costs on our own, right? I think one thing that we've thought very creatively about is how can we use our networks and our supportive ecosystem to help us get there along the way. And I know the last question we'll ask a little bit about that. And I can't behoove how important it is to think about that in your own allocation strategy. If you're a foundation, how you give away your philanthropic dollars, not just your endowment, to support fund managers to get off the ground. These are risks that we take not only from our own professional standpoint, right? This is something that I'm going to do hopefully for 10 years, but much long beyond that, right? Because it's not just a fund that I'm creating, but it's a firm, and it's an institutional firm that we are bringing to the market. This is going to be our life's work and a continuation of the experiences that we've had to get us to this point. I think on the personal perspective, we are all women, and we are not shy. Health insurance, we have to carry babies. We've got to, support families, right? I think this is something that's a much broader conversation, but many of us don't take salaries in these startup phases, right? My husband is also an entrepreneur, so this is very much so a discussion in our house in terms of who pays for what, right? And I think, again, right, if there are programs, if there are opportunities to help us kind of support ourselves from a personal life perspective, in addition to the $1 million to $3 million that it takes to start a fund, I think that can move boundaries quite significantly and actually diversify, frankly, what a lot of people in this room look like, right? Actually representative of the cities that we represent, right, of the places that we represent, and of the founders that we ultimately want to invest in.
Thank you so much for teeing that up. We often talk about funds typically break even at about 50 million in assets, and a lot of first-time funds. If you've never done something before, how are you going to find $50 million? How are you going to get people to trust you, believe in you? I appreciate contextualizing the amount that goes into this. Michael's question around like what are some of those costs? They are staff salary to live, to be able to do this work, the technology to have a like legitimate seeming professional experience for your investors and for your investees to work through. All of the different SaaS subscriptions that you need to get, like your data room software, your this, your that, everything adds up. And to be providing a professional experience, because underlying the question that investors have is, can I trust you? They want to see that this is not just something that could fall apart, a fund that could disappear at a moment's notice. So you need to build all of that infrastructure that says we are professional, we are committed, we're in this. But even beyond those operational costs that every business would have, there's also how do you fund your first deals? How do you have what, I'm going to unpack some jargon, GP commit, general partners for those that have an equity structure where it's a general partner and limited partners that are investors. That's a conventional equity venture capital model. Not everybody's raising venture, so just getting us on the same page. But a GP commitment is usually a sign that some institutional investors look for to say, do you have skin in the game? Like, is it not enough that we've been unpaid and have no health insurance? We have skin in the game, but they want to see that there is a commitment from the managers to actually participate in this. At a $50 million fund, this is what? Can you math with me, people? 2% of 50. One. Thank you. Put in your own $1 million to be able to participate in your own fund in addition to all of the things that you've taken a back seat for your life. That's really challenging for those without generational wealth, let alone if you were to do a second fund. So I'm talking about this being her life's work and not being fund 1, but fund 2, fund 3, fund 4 in the future. Each of those tend to be at a larger fund size, and that's a larger commitment from the general partner to seed the fund to show that you're committed. Why? Because we're trying to build an uphill battle around trust, around you can believe in me, you can believe that we're here, we're focused, we're dedicated to the work, and we have a good read on the landscape. I don't really see how, frankly, I'm very biased about this, but I don't believe that GP commitments are the best indicator of commitment to the fund. And it privileges those that do have access to networks of wealth, and it makes it so much harder for those of us, women of color and others, that have a harder time with finding how do I get started? How do I build this to even have my foot in the door to build a fund? I mentioned one last piece, and that's on doing your first deals. Again, it's all about building trust. And investors, I love you all, but everybody's first 2 questions are, what deals have you done and who else is in? And so what deals have you done? You need to also have put your own money out to be able to get people to commit to the thesis. You need to show, here's our first transaction, here's an illustrative example. Yes, this is a novel thesis because you don't know what it looks like to invest in underinvested communities. It hasn't been done, otherwise it wouldn't be underinvested. But you need to prove how this can work and why this is possible and the kinds of networks that you have to generate deal flow that's emblematic of your thesis. But again, that money has to come from somewhere. So that's where we've built a fund that's helping to do warehousing of first transactions so that emerging fund managers like these women beside me can be able to do their initial deals and show to their LPs or other investor structures what they mean, what they're talking about this.
Wow, thank you. And first, a clarification. Sona mentioned her partner is Laura. It's not me, it's another Laura, right? So just to clarify, we're not partners, we're just co-panelists. So I think what you mentioned and the bias that you mentioned about wanting people that look like you and feel like you, blah, blah, blah. Imagine Mexico. It is a very unequal society. Inherently, inequality drives to insecurity, so the trust issue becomes super important. And so what has happened in the private capital industry is that there's a ton of Mexicans that only fund people that went to the MBA or graduate school that, you know, that they went to. I'd never been to a graduate school. So it's always like breaking the paradigms that I think in my first SOCAP, I was here in 2014, and I remember hearing that friends and family gave them like $500,000 to start. I'm like, what? What? That is just super surprising. Friends and family that can give you that amount of liquidity, wow. I mean, that is, I think there is a privilege to entrepreneurship, and there is an even bigger privilege to fund management. And I believe, yes, privilege comes with access, but it does also come with blind spots. It's not just in the gender-related blind spots, in the underfunded and BIPOC communities, and like there are so many blind spots. Like this spring, I was in the private capital conference in Mexico, and I was the only person in the table who uses public transportation daily or like regularly in Mexico City. And I was like, you guys are missing out. You guys are missing out because you're supposed to make the decisions of like what is going massive or what is going viral or where is going, and you're like not looking at the trends daily as I am. And so I'm not even funding urban stuff. I'm doing rural, but you know, it's just, I think there are blind spots to that privilege that we need to overcome in a more equitable way, and really inviting the people that are diverse to the table make a lot of decisions sense. And I just think there's a lot of talk in impact investing about what to fund and what is underfunded, but it's also who. And I think who is part of the how, and it's part of the why. Like if we want to really question the paradigms, and if we really want to transform that domination dynamic of finance to an interdependent dynamic, the who is doing the decision-making of the funding really needs to be questioned and needs to be very much more inclusive. So not just gender-related, but every other type of inclusion. So I think I'm having the same barriers as you, and I think my co-founder is also having those kind of barriers where, you know, we've put blood, sweat, and tears, and it doesn't count as the 1%. And in Mexico, the prices are different. So break even, you can have a $20 million fund and it's okay. 50 million for us, like, wow, that would be like fund 2, fund 3. So it's like, it's a tiny industry, way tinier than here. The capital flows are not flowing. And also the investor dynamic in Latin America is more like, you know, I already have enough risk. Imagine like I'm a wealth owner in Latin America, so usually their investments and their companies are already at the currency risk of their own country. So they want their investments to be elsewhere to diversify that currency risk, right? Especially if they don't like the current president, who they don't. And so that is really hard, you know, a really hard barrier, because I come to the US and everyone wants to fund the US. I come to Mexico and everyone's wealth wants to go to the US. So it's like, who's funding impact in Mexico? Right? Who is? And so if like there's so many funders now in the US that are now waking up to the amazing opportunity that is regenerative agriculture and the regenerative transition, and there are so many funds growing in the US, and it's amazing because there's layers of financing available. I'm like, wow, this is amazing. But like 70% of your food systems depend on Mexican food systems. We are absolutely interdependent. So I think Mexico can really be a portal, because we are in a position, the geographical position of Mexico is being a bridge from the global north to the global south. And that comes with a lot of dynamics. And so I feel like Mexico is a translator place, a bridge place, and we can really be a learning ground for the US, you know, funding strategies and impact investing strategies to start learning about, you know, Latin America, the rest of Latin America. And I think we can be a learning ground, and I think, you know, that opportunity is the time is now, because, you know, we don't have any more time in terms of climate adaptation, and we really feed, part of the U.S. already. And so it is really important, I think, to listen to the Latino farmers in the U.S., but it is also really important to see where are your suppliers in your food systems, and really fund in a more systemic and holistic way.
As I listen to the three of you share about your experiences, it reminds me of the fact that, like, this is the benefit for investing with first-time, with underrepresented fund managers, is that they are close to the issues, that they are approaching investing differently, and have unique mindsets and opportunities to invest that would benefit investors. I mean, it sounds like what we're all talking about is funds that not only benefit the community, but also specifically benefit the investors in said funds. And so the paradoxical element that I think you've all touched on is the idea that there are some sort of structural built-in components that act as inhibitors for the same sort of fund managers who would otherwise be a boon to communities, to investors, and the like. And I think Sonam's comment about the GP commit 1%, 2% threshold in some cases, it oftentimes maybe seems to the institutions who invest in funds like a negligible quantity, and yet it is an insurmountable hill that would prevent even many people from the idea of launching a fund, because they've heard that that's a component of the idea of launching a fund. And if the idea of such a concept is to ensure skin in the game, I think we've just heard that sort of the skin in the game is par for the course. There's a guaranteed skin in the game when you put your whole life on the line, when you risk your professional career, you risk losing an income, you risk being without health care. That is much more than somebody who comes from wealth putting 1% of a small fund on the line of their own sort of, familial resources or otherwise. And the lack of friends and family capital and the lack of sort of access to some of these institutions really does sort of prevent sort of like the people we want running funds from doing so in the first place. This paradox makes me think of the next question I wanted to ask, which is specifically about institutions who invest in and with emerging fund managers. SOCAP is a great example of sort of the diversity of institution types, and there are many institutions who attend SOCAP who I think would at least say we are committed to supporting, investing in, or at least sort of cheerleading emerging and underrepresented investment fund managers. A lot of the concepts we've talked about this morning, I'm sure, are not lost on the audience here. And yet, in our experience, and I would hope maybe you all can share some particular experiences, we see that the institutional investors, so to speak, the large institutions with name brands, big foundations, endowments, you know who I'm talking about, they have the greatest potential to make a difference with backing small, emerging, underrepresented fund managers, and also some of their sort of institutional rules, policies, whether sort of self-imposed or otherwise, make it paradoxically difficult to participate with fund managers. So the two elements that I'm thinking about, and I'd love if you all could expand on your experience with these things in particular, are the fact that big institutions often say, we won't back funds under a certain size, because they say we will cut checks of only X dollars and we can't represent more than X% of a fund, so therefore that limits us from participating in funds under a certain size. Love what you're doing, think you're great for the world, will invest when you get to fund 3 and it's $100 million. But of course, if you can't raise money for fund 1, the odds of getting to fund 3 are infinitesimally small. And so the idea of institutions sort of being the most risk tolerant in some ways, the greatest ability to sort of like cause follow-on effects with other institutions to follow, and yet imposing sort of these limitations of making sort of only commitments to funds over a certain size does inherently bias them away from the smaller underrepresented managers who come from communities without wealth. And the second layer, which Sonam addressed a little bit, is the idea of sort of the institutional caliber of a fund, where many institutions will say, we'd love to back you, but you don't use fancy law firm X, Y, or Z. Or we'd love to invest in your fund, but unfortunately we need you to do an audit. And they're the only investor you're talking to who requires an audit, so there's another $20,000 annual expense. And these institutions consider the fact that maybe they are professionalizing your fund, maybe they are helping you grow into the sort of institutional caliber fund, when in reality they're imposing challenges that no other investor may require of your fund, and just stacks the costs up, and may even make it such that if you're performing these reporting and audit and sort of additional overhead and administrative features, you may end up spending more than that money is worth to bring into the fund. So I have a strong opinion about the idea that institutions could and should back emerging managers differently. I would love to hear in your experiences, how has this played out in your world? Have you seen firsthand examples of how this works with you and your fund or peer funds? Please.
Okay, so as you saw, Kishori couldn't be with us, and Kishori was representing USAID in this panel. So I do want to give an enormous shout out because USAID has been supporting us in that kind of work, precisely like the amount that we need to pay the fancy lawyers, that has been paid for by USAID, thankfully. So I think so in my Instagram, I mistakenly put the hashtag SOCAP14 instead of SOCAP24, and I found out photos of the SOCAP14, and it came out like it was a post-it that said USAID may fund the full spectrum from grants to investments and equity, and I was like, wow, and it came true for us. So I think the USAID people in Mexico have been amazing. I do have to say, it was women-led. That grant happened, and I do think that makes a difference. And she's also a biologist, so she loves our thesis. So I think USAID has change makers within it that are really, really transformative and are really doing cross collaboration with other agencies like the DFC that are really hitting it out of the park. Like for us, we have not only received support in the terms of grants for the structuring, which was absolutely fundamental, and we couldn't have done it without them, but also they like make a point in very, very intentional in their PR about how they talk about us, how they support us everywhere they go. So it's like, it's really amazing support. The other two organizations that I want to give a shout out, if you guys, I saw that many of you are GPs and fund managers. So like if you're in the climate space, the International Climate Finance Accelerator in Luxembourg was also an amazing program for us. So they are in Europe and they help you fundraise in Europe. So to your point of the $50 million, over there is like, if you're not a €100 million fund, it doesn't even make sense that you incorporate in Luxembourg. So it's a huge burden of regulations, as you can imagine, and they teach you, they give you courses, they pay for your mentors, they pay for your coaches. It's like, it's really amazing, and they pay for a little bit of the roadshow. So part of what Lauren was mentioning of the expenses, the roadshow and these conferences is super expensive for us. It's not only the ticket to get into the conference, which I was invited to, so thank you, but like the travel expenses are insane. So really they help out with the roadshow and everything. And then there's another one, which is the Climate Finance Lab, the Innovation Lab from CPI, the Climate Policy Initiative. They're doing an amazing job. So both of those programs really support emerging fund managers from emerging markets mostly. And that is very helpful. I would say those two programs really make a difference, and USAID does too. And in terms of the funding from the development finance institutions, I've been told that, like, if it's not a $50 million fund, you can't do it. And I'm like, you're development finance, remember? Development? No. But I wish I could have said that. But really, it's really hard to have those really, really high thresholds. It's for the Black Rocks.
Hearing about that Luxembourg program, I'm like, I want one. Not just to go to Luxembourg, which sounds great, but particularly, it's true, this being out on the roadshow, I am not working in the business, I'm working on the business today, and this week, I'm out here connecting with you, which is delightful, but it means I'm like, oh, my Slack is blowing up. There's a ton for me to get back to when I'm not here, and that's a cost. It is a cost for fundraising. People need to understand what that goes into. And I think the other piece that you were talking about with both you, Laura, and Michael, around like riding the bus, riding public transit, and having proximity to the communities that we're investing in, that is 100% our thesis and what also sets us apart. One fund that we're raising, I'm, by the way, Irish, Chinese, and Native Hawaiian. I will talk about indigenous things all day long. But we have a fund that we're supporting nation building and indigenous tribes in the United States context. And I spend so much time doing Native 101 to folks who want to invest in Indian country and have no idea what that looks like. And so the amount of time, like, it's what sets us apart and makes us a valuable possible part of a portfolio for the kinds of impact that institutional LPs want to be having. And They can't get over their own blind spots around what do I not know about these communities? What do I not know about cultural context that could affect the capital flow and affect the rate of deployment, affect all of these things that we think are like, well, this is just standard. Like, no. That's standard in an urban tech context. That is not standard for the communities that we're investing in. And so what those implications are, that's a heavy burden for fundraising, for storytelling, and it's also a heavy burden for the narrative reporting. You asked, like, what are some of the other costs and how could it make things better? I wish, if I could wave a magic wand, can we get away from a 2% standard fee structure? Management fees of 2% on the fund. If you are asking for special things, for deeper impact work, for longer time and more involvement, you should be expecting to pay 3% for your fund. It's not going to be the same as a hedge fund manager that's just doing bread and butter, normal Fund 6 thesis. We're going to be doing something different. You want us to be delivering something different, you should pay for that. So I feel like if I could wave a magic wand, people would accept a higher fee threshold for impact funds in particular.
Yeah, cannot emphasize that enough. I can't tell you how many times I have other folks, generalist tech investors, folks who've been in the venture industry for 10 years, and climate is now hot, so they're like, oh, I want to get into it, and I want to make money off of it. Calling us, asking us for our expertise, not paying us, right? It's so much of this is, oh, you're there, you know what you're talking about, can you share your experiences, right? But then not put your money where your mouth is, and we see a lot of that across this industry. So I think that certainly resonates. Maybe I'll start off just by talking about some of the programs that have helped us to get to where we are. First and foremost, Catalyze, right, is a program that Michael's team runs. They have been incredibly supportive for us, both providing us a grant of $20,000 so that we can come to conferences like this, right, and pay for it. But also actually helping us dot our I's and cross our T's in terms of getting our fund off the ground. So it's a 6-month fellowship program. We had conversations every 2 weeks on where we were, what we needed help with, how we were thinking about our fund admin, which legal firm to take on, how should we structure our promissory notes and our advanced capital commitment from one of our LPs to be able to support us in our early deals, right? That is incredible amount of technical support that we would not otherwise have because we don't come from the venture industry, right? We come from climate. We know our stuff in our particular domain expertise, and we are trying to bring that knowledge to our investment principles, right? So I think that is an incredible, and thank you, right? I will use this public forum to say that, right? For supporting us there. Another program that's incredible, and I will shout out Caroline over there, is the Recast Capital Program in partnership with Pivotal Ventures, which is Melinda Gates's organization. And Recast has similarly supported us both through an enablement program, which provides a lot of that technical support and diligence as we get off the ground, in addition to an incredible community of fund managers, right? We are one of 30 fund managers in the Accelerate program, and they are great for deal flow. They are great for sending a WhatsApp message on who's coming to SOCAP and what events should we be going to, or right, or what panel should we pop into. Sharing LPs, right, because it really does take a village. And sort of the cherry on top of all of that was that the Pivotal Ventures, in partnership with Recast, provided us $100,000 to help us pay for all of our fund expenses. Like, they are our friends and family, right? They are the ones paying our legal bills, our fund admin, all of the things that we were talking about earlier in terms of the costs that add up. And then one last one, I don't know if Nina and Milton are in the room, but VC Include, oh, there he is right there. VC Include, which is also supportive for women and diverse fund managers. And again, an incredible community of other GPs with very, very different strategies, from indigenous, supporting indigenous founders to climate tech, financial inclusion, equity. All of these programs have been supported by foundations. And again, right, putting your money where your mouth is, not only in terms of your programmatic dollars to support these programs so that they can in turn support us, but then also building a pipeline for your own endowment investments, right? So that when we potentially do get to Fund 2, Fund 3, Fund 4, right, and we meet your minimum $100 million thresholds, you have a pipeline of incredible managers that have been fully vetted so that you can invest in those. I'll also call out a couple of foundations that I think are doing incredible work in terms of shifting their endowment assets to mission-aligned investing. Andrew McConnell Foundation in Canada is doing that. The California Endowment is doing that, right? And it's really thinking about, you know, on our website, we say we want to focus on climate and community and resilience and supporting women and diversity and financial inclusion and all of the other things that we're looking for in terms of our, you know, how we can have an impact and use our dollars to do that. And then also doing so on the financial investment side, right? And I think for us, as fund managers, we have a fiduciary responsibility to all of our LPs, not only to return the capital that they put into us, but to knock it all out of the ballpark, right? And return 3, 4, 5x on that capital. And the more diversity that you have and the more different perspectives that we bring to the table to invest in founders that are building incredible businesses, the more your endowments will grow, right? And that is really part and parcel of how you think about aligning both your programmatic activities as well as the endowment. I think on the gender lens side, right, is something that as women, we're all very passionate about. Women fund managers are twice as likely to invest in women founders. Those women founders are then 6 times as likely to hire more women on their team. Women control about $32 trillion of spending power across the world, right? These are huge numbers. And it really starts with that initial flow of capital and where that money goes. And I think that it behooves us to think about that and think about where we're putting our money and talking the talk and walking the walk.
That's such a good point. 2 things. One, I will double down on Sonam's suggestion, like use a grant portfolio and as a search fund to support a lot of different fund managers that may graduate to your program-related investment or mission-related investment portfolios. It's terrific. I can't say that enough. We have some of that from both the California Endowment and the Robert Wood Johnson Foundation. It's been wonderful to have that kind of support, and more people should do that. Just hint, hint. Second piece, I think, is around women fund managers. Because of all of these challenges that we've been talking about on cash flow and access to capital, how hard it is to raise a first fund, then we're seeing it harder to raise a second or third fund, or if you've been in the venture context, to move into larger check sizes, to move from seed to Series A to B and C. And so we're seeing the downstream effects of that on businesses that they would be supporting, that the portfolio companies that the firms that we're talking about have been investing in early are now wondering, where does my Series C come from? Because there's no fund manager that's been able to get to size that can help us to grow. That's what we're talking about, these effects of the cash flow challenges. Michael was saying this is universal, it's not niche. It really is, how do we build an inclusive economy? We need to have even representation throughout the full continuum of the capital spectrum. And that is how we end up actually growing a diverse set of businesses so that they can make an amazing inclusive economy.
Yeah, incredible. Couldn't have said it better. If you were listening to Sonam describe the sort of network of support for emerging underrepresented GPs, first of all, thank you for the kind shout outs. We totally agree about Recast, VC Include, the need for these organizations to sort of exist in the earliest stages of helping folks spin up their first fund. But as you hear Sonam talk about she and her partner Laura's work, you haven't even heard them talk about her investment thesis. You should ask Sonam after the fact about what they're investing in. But you can imagine how we got excited learning about Street Life Ventures and Laura and Sonam's mission. And it's just the fact that they need some help getting sort of like the bureaucratic, boring stuff out of the way to do the incredible work of investing that they're inevitably going to be successful with. And there are infinite fund managers out there that are in the earliest stages with a fantastic idea, unique expertise, a fantastic idea about sort of an investment fund model and thesis. And it's just simply the logistical elements of paying for attorneys and figuring out the sort of like rote, boring fund management tasks that need to be sort of sorted out so that you can essentially let these all-stars make the right investments and return great investment capital to their investors and make the world a better place. And so we see, in our perspective, the idea that like sort of like market rate funds that have ambitious GPs with amazing ideas that simply just need a few things sort of like knocked out of their way being the greatest potential for impact that we can create. It's, you know, small dollars in the grand scheme of things to help a Street Life Ventures get to that successful first fund, which inevitably leads to funds 2, 3, 4 that continue to grow and make huge impact around the world. So I'm excited listening to Sanam talk about these things, and I hope that you can feel why we continue to be excited about fund managers like these. We are running up on time. There's one thing specifically I wanted to ask each of you to touch on, and then I wanted to make room for Q&A. I have some cards in my hand. Continue to pass these up if you can. I'm not going to get to all of them, but still I'll filter through and we can make sure that you can approach the panelists after the fact. Sanam addressed this specifically, and maybe you could double down on it a little bit. Thank you. The idea of how you're paying for this stuff. I mean, look, we've talked about in abstract terms, it's expensive, there's a lot of bills to pay, there's service providers, you got to travel and stuff. So how do you do it? And how have you heard people do it? Give us a way that you have either done this yourself or seen a GP pay for these early costs that worked well, and then sadly maybe something that you've seen that didn't work so well, predatory terms, some sort of capital solution for the earliest stages of a fund manager that like didn't work out well. Could be yourself or someone you know. Sadly, there are too many examples of this, but help the audience understand how these bills are really getting paid in the early days.
You all, right? The early days, right? We used our grant from Recast Capital and from Catalyze and our community network from BC Include to help us pay for our legal bills, our fund admin, our CRM platform, all the tech stack, right? And now AI tools, right? All sorts of things that we use to go out there and raise the fund. And that is beneficial for our LPs because those costs are grants. They are not allocated as fund expenses. It increases our IRR and again, right, our return on capital. So I cannot emphasize enough how incredible that support is, right, from those philanthropic institutions and those dollars. And as Michael said, right, these are small dollar amounts, right, but it really, really helped us get off the ground. A very supportive partner. I will shout out, he's not here, but if he's looking, you know, on video, my husband Yen, right, in terms of just taking care of the house, right, while I travel, while I do this, right, while I'm on the road. And again, right, as a 2-household family where both partners are starting their own businesses, I think that's incredibly important, right? Probably the best decision I certainly made in my life. And then I think the third thing is, again, right, that community. And I often say it takes a village, but in our case, it really is a city, right? Not only do we focus on cities, but it's a huge network of people, whether it's LPs. Even if you cannot invest in us, right? I have had countless number of people who say, hey, I can't invest in you, I'm not allocating right now, you know, we're not doing climate, whatever the case might be, but here are 5 other people who we think really resonate with your thesis, and I will take the 5 minutes to make that introduction, right? That goes so far, and we've been able to use those networks and that power of that introduction to get to where we are, right? So those are awesome things. Maybe just one small thing that I think we see a lot of in terms of the predatory side. You know, I think when we first started fundraising, we talked to so many allocators, and they're like, "Oh, why don't you actually come work for us and do this internally?" Right? And you know, you have such great experience, and your thesis is really unique. And it's like, well, you know, I'm doing this for a reason, right? I am starting this because I both believe in myself and Laura, right? But I also believe in the founders that we're going to be supporting. So don't say that. I think the second thing that I would say is there's sort of an entire industry of folks who take GP stakes. And it's not always a bad thing, right? But being creative about how you structure those GP stakes and not being predatory, right? In some cases, we've had people who want to take a huge percentage of our carry, right? This is, again, our life's work, our future income, right? And I think, frankly, our management fees pay for our future, the firm, right, in terms of who we hire and what that looks like. So I think being creatively about how you structure those, if that is your strategy, and ensuring that the GPs aren't sort of giving away all that upside, right, especially in those early days.
That is a good cautionary tale. I have met several of those fund managers who have, because they didn't have networks of personal wealth, they had to accept somebody else to be part of their GP team, and because they split it based on who contributed what upfront financially. That does not account for the even contributions of intellectual property, of lived experience, and so it continues to perpetuate a cycle of inequity of who had money coming in gets the carried interest coming out, and I've seen it happen too many times. I don't want that anymore. So I do think pricing these intangible values of lived, learned, and labored experience, if that's what's giving you alpha and giving you an edge in your thesis, you should price that, and we should have more even sharing if you do take on external GP commitment support. For us, we've funded a lot of our work through grants, even though we are a for-profit, certified B corporation. I write a lot of grant proposals. I spend a lot of time doing grant reports. I have 2 due this week. And so that has been a challenge. Yeah, I do not recommend getting expenditure responsibility grants into a fund or into a for-profit company. It's a headache, but it's how we did it. So it's only because I spent a decade as a nonprofit fundraiser before. Do not recommend. Do not do that path. If you have a nonprofit structure, yes, that's totally fine. A lot of the more restorative funds, that's a great way to build up the ability to put in fund equity that's not coming from the manager personally, is getting grants. That's what we've done with Hawaii Investment Ready and the Aina Aloha Economy Fund. They raised a ton of grants to be able to go into the fund to cover fund expenses and also serve as loan loss reserves. So that is a terrific way to build a model. There's lots of things I could say about what has not gone well, but I will pass it to Laura.
I mean, for us, it was a program called Sustainable Landscape Ventures that was funded by USAID again, but implemented by Conservation International. So Conservation International in Mexico really helped us out build the pipeline because we are funding and partnering for nature-based solutions and the regenerative transition in rural Mexico. This stuff is not, investments that you find. It's investments that you build and that you catalyze. And so there's a ton that we've done since 2018 to be able to get to investability for this pipeline. And there's also a grant from the IDRC, the Canadian Research Development Finance in Latin America, that is helping us map out the potential future pipeline in the rest of Latin America. So they're amazing.
Great, those are good examples. I am aware of the fact that we only have maybe 5-ish minutes left, so I'm going to try and combine a couple of these Q&A questions. We'd still love to hear from you all. We'll hang out after the panel as long as we can in this room, so please come find us. I have 2 questions that I think are somewhat related, and they allude to something that Lauren mentioned, which is one of my favorite investory buzzwords, alpha. And I think if you're not familiar with sort of like the VC terminology, which I certainly wasn't at a few years ago, the idea of alpha is something that's like sort of your unique proprietary competitive advantage and edge and the sort of insights that you have that are bespoke, distinct to you. I think that actually we oftentimes, and somebody's question alluded to this, we oftentimes have trouble with branding emerging underrepresented fund managers as something charitable, something that is sort of concessionary in nature. I mean, even now we're talking about the idea that it's hard to raise a fund and it might be helpful for grant funders to step in and take up some of those costs. And yet also, we must be able to hold in the sort of simultaneous tension in our minds that these funds for the investors could theoretically be quite lucrative. And in many cases, small funds and first funds have the greatest ability to return many multiples of the fund because of the nature of small early stage investments and a small fund. It's easier to return 3 times $20 million to your investors than it is 3 times $300 million. So the idea that small, emerging, underrepresented led funds are a charitable cause and also that they offer this unique proprietary alpha and opportunity for investors, seem to be in tension. And it feels like in many cases when we talk about philanthropic capital, there is somewhat of a charitable signal. When if you're a fund that receives a charitable contribution in one way or another, a grant to cover costs, a PRI investment into the fund, it might signal to the market that this fund is inherently charitable. How do you negotiate that with your funds? How do you sort of get investors comfortable with the idea that actually diversity in your representative team is an asset, not a liability? It's not something that needs to be sort of supported with charity because it's harder, but in fact, it's just overcoming those early obstacles to unlock the ability for you to be sort of more successful than racial majority, gender majority peers in the investment management space.
Okay. Our team is 47 people now, as majority people of color, majority women, about 40% are first or second generation immigrants. That is, we're performing well, and so I'm like, anybody who has beef with diversity in the industry, come talk to me, because I think it actually makes us stronger. I fundamentally believe in all of the data around decision science shows that diverse teams create better decisions. It might take longer because y'all's brains don't work the same as mine, but it's a good thing. It's a good thing for us to work through what might be the challenges, get rid of more blind spots. So that is my push on this is a charitable activity to have a woman of color-led firm. No, it's working great. We are around 250 million assets under administration, which is on the large size for impact, but it's on the small size for the general financial services industry. And that is something that we are always grappling with is, okay, you started in this somewhat concessionary. I'm like, hold on, you want a lecture? I'll give you a lecture on macroeconomics. We'll do this. We'll talk about how impact is internalizing externalities and that this is part of the return profile, is to create a society where we are not gonna have those same challenges that are gonna cost you money 20 years down the line. The other side is that we are designing funds with a variety of return profiles, from 0% COVID recovery fund to one that's got a target 16% IRR, and everything in between, because we're targeting what's most appropriate for the community that we're working with and for the kind of impact that we're creating. So if you don't want that kind of return profile from this particular asset class, I will interrogate you as to why, where you see the risk, why you think that's why you think that is a more appropriate to be somewhere at a different level. So I will argue with investors kindly, but really invite them into conversation and get into, probably because I have a philosophy degree, like, what's the question behind the question here? What's underlying this curiosity around a pushback around thinking that because we're investing in underinvested communities that it is concessionary. I hate that word.
I think there's an over-subsidization historically of the extractive industries. And so if those have been, over-subsidized for centuries and are still subsidized with trillions and billions of dollars of public and private funding, how can we compare? How can we benchmark? It's like when people ask me, what about all the risks that will play out in your fund? I'm like, what about all of them? They will all play out. Of course, I'm in drug lord territory in rural Mexico, for God's sakes. All the risks are there. But all of those risks taken into account, it is still riskier not to invest in the regenerative transition. So we are over-subsidizing our extinction. Compare that to whatever grant we're asking for, just.
Yeah, 1,000% agree. I will just say, I hope that Laura's Instagram, when she types in, SOCAP24 10 years from now, that we are frankly not having a conversation about diversity. We are people, right? We are people. We are putting our entire life's work into this, and we are going to, again, knock it out of the ballpark, right? So it is about, again, fiduciary responsibility first and foremost, and diversity lends itself to that.